Welcome to our first webinar of the year about economic implications of a new income or sales tax in Alaska. We're just now getting started, and so I appreciate everyone that took the time to join us this afternoon. My name is Eric Cordero Georgiana. I'm the new Vice President of Operations at Alaska Policy Forum. Please note that today we are recording the webinar and it's being streamed through Facebook Live. We will make sure that the recording is made available for you if you want to come back and listen, watch it. Thank you all for joining and to hear from our guest. He's going to present information that is very important and very timely right now on a study that was commissioned by Alaska Policy Forum to determine the impacts of potential new taxes in Alaska. We hope to have time to ask him questions towards the end. To ask questions at any time, please type it into the Q&A box. Questions may be limited by time. And without further delay, let me introduce our guest today, Mr. Jared Walczak. Jared is Vice President of State Projects at the Tax Foundation. He's the lead researcher on the annual State Business Tax Climate Index and Location Matters. He has authored and co-authored numerous studies and tax reform guides throughout the country. His work is regularly cited in the New York Times, the Wall Street Journal, and many other prominent national and state outlets. So without further ado, Jared, the floor is yours.
Thanks, Eric, and thank you everyone for joining today. I'm joining from Washington, D.C., where we still don't have a organized house. I understand that Alaska is working on some of those things as well, but I wanted to talk to you today about a different issue, an issue that has obviously been more front and center over the last few years. Alaska is one of the very few states not to have an individual income tax. And there's then this question, because you were actually the only state to have had one and not had one, being repealed after 1980 with the significant surge in oil revenues. The question of whether an income tax is the right choice for the future, whether it's needed, whether some changes needed, and what the consequences of an income or even a sales tax are. There are 9 states, including Alaska, that do not have a wage income tax. We know that there are a lot of advantages to this. We can see some of the growth in some of those states. We also see, though, some of the economic implications and the revenue implications for Alaska of the heavy reliance on taxes on one sector. Alaska, of course, has a very unique economy. So I'd start with this, if you can all see the slide here on labor force participation seasonality. This is just radically different than what you would experience in any other state. You can see the US average here, where there is some seasonality. Typically, there are more jobs towards the end of the year than there are at the start. Some of that is the Christmas rush. Some of that is when construction jobs happen and fall off, things like this. But it's not that significant. And in Alaska, of course, you have much more seasonality. You have workers who are in the state for part of the year. So you can see this significant seasonality associated with labor force participation. This obviously will have implications for any income tax. Part of this is that you have a lot of, not only seasonal, but workers that are only in the state part of the year. So this is just one aspect of how Alaska is very different than most other states. Even more significant is the reliance really on one substantial industry. I don't want to overstate this because there are many important industries in Alaska. But to put this in context, the oil and gas industry is responsible for less than 1/2 of 1% of employment in Alaska, fewer than 1 in 200 employees. It is, however, responsible for 12% of gross state product. In some years, it's been significantly higher than that. And this is key, 81% of the state's own source non-investment revenue. That is, other than the revenue that the state raises through investments of what's in the permanent fund and other funds, 81% of the revenue coming in fiscal 2021 was from this industry that employs 1 in 200 Alaskans. That's heavy reliance, and that's why you get this cyclicality, why you get this volatility that has obviously been a significant issue. Heavy reliance on the energy sector is a blessing and a curse. The blessing, of course, is that It means far lower taxes on everyone else. And it means that you can export a very significant portion of your tax burden, because much of this is borne by people around the country, around the world, who are consuming these energy products, and by the companies that are participating in this. The downside, obviously, is that you have seen the fluctuations in revenue from year to year, and going into, say, 2020, where the oil prices, spot prices had really bottomed out. Even Texas Intermediate was negative briefly, and you see the huge concern, and you see the forecasts. Of course, this changed, and the markets for oil have been very favorable for Alaska recently. You've replenished some of those funds. You've seen really substantial revenues, but there is always this concern with something this volatile. How do you buffer that? How do you address it? And is some other form of tax appropriate? So I want to discuss that and talk about whether the income tax, or really any other tax, can accomplish that. Here is the problem. So look at the forecasts. I went back and I looked at the last roughly decade of 10-year revenue forecasts, and you can see those lines are what was forecast for the following 10 years after each of these points, and then the light blue shading is what actually happened. And what you can see here is that, for a year or two into every forecast, they make some sort of estimate based on current projections about what the oil price is going to be, and then it's basically straight line after that. And what you can obviously see is that in reality, it's been nothing like straight lines. So none of these projections really seem to ever pan out past a year or two. And maybe no one could really expect them to, but it's a huge difficulty, a huge challenge for Alaska. And what it requires at a minimum is a lot of smoothing. It requires heavy reliance on these funds, on rainy day type approaches where you are smoothing this volatile revenue over multiple years. One of the issues right now is just how much money we're talking about. So Alaska revenues approached $30 billion in fiscal 2021. Let's break down what that is. That's about $117,000 per household. Now, the median household income in Alaska is less than $78,000. Total personal income was about $49 billion. So government revenues that year were 61% of personal income, and they were significantly more than the income of the median household. Now, this is hugely anomalous. The national average, compared to that 61%, it's 13%. That's a huge difference. Now, 2021 fiscal was a very good revenue year for Alaska. But even right now, the current forecast, I believe, is 34%. And it seems like it's bouncing around for the future, the next couple of years, looking at 30 to 40% of personal income. This is extremely high. Again, fairly good news. But it means that it's extremely difficult for any sort of other tax to come close to providing a significant buffer for this. Alaska actually did once have an income tax, as I mentioned. The last time that was in place, the top rate was 14.5%. Which obviously is higher than anything that exists in the nation at this point. The highest right now is 13.3% in California. They're actually going to push that up to 14.4 next year. But your last income tax was slightly higher than California will have on millions of dollars of income next year. And yet, what would that do? You think, okay, we're clearly not going to have another 14.5% income tax. No, you're not. But if you had that 14.5% income tax in place in fiscal year 2021, what would it have increased revenue by? How much would it have provided a buffer? The answer is 1%. It would have been a 1% increase in your revenues for that year. That's it. Because the oil and gas revenue, the oil revenue really just so massively outstrips anything you could do on the income or sales or really anything else side of things. And this is the fundamental problem. I've talked about it as the problem of big numbers in Alaska, that the numbers we're talking about where the current revenue is coming from are so massive that anything else you can do can have a significant impact on your economy, can be a significant burden for individuals, but it's a drop in the bucket compared to the revenues you are currently raising. If you look at what the current revenues mean, you look at just how much they are bringing in. Let me see if I have some numbers here, but basically you are at like 150, 160% of, let me see if I apologize. I have some numbers I wanted to share with you that don't seem to be coming up for me right at the moment. I will get to those later in the presentation. I think I have those. But again, the reality is that you would not be able to raise most of this, from an income tax. Here we go. In 2020, the state spent 149% of the national average as a percentage of gross state product, 151% as a percentage of personal income, 161% of the per capita average. Sort of choose the approach you want. The reality is that Alaska is spending about 50% more per person or as a percentage of income, at least, than other states are. And they're doing this almost exclusively through money that's coming from oil and gas and from investment income. And there is just this huge challenge. Any other tax that you add is going to have a relatively modest impact on those revenues. Smoothing that is always going to be bigger, no matter what you do. This is going to be your primary source of revenue. So I mentioned that, again, that previous rate was 14.5%. And that would have only raised 1% of your revenue in fiscal 2021. To raise sort of the average amount, what other states raise from their individual income tax, which is about 13% of total revenue, about 43% of state tax collections, you'd have to raise $4.5 billion a year from your individual income tax. Now, that's not possible. Let's put that in context in another state, a very high tax state like California. They have a top rate of 13.3%. And it kicks in the top rate doesn't kick in until you're getting really high income, but it's a 9.3% rate above $61,000 in income. The median household has a top rate above 10%. And what do they bring in per household? About $6,450. And again, to just get the average amount, the average percentage of your revenues from an income tax, you would need to raise $17,600. If you're doing the math at home, that's almost 3 times as much as California can raise from its highest in the nation individual income tax. This doesn't immediately rule out another tax. It's just to make clear any tax that's under consideration is going to raise a very, very small percentage of state revenue compared to what you already have. And then you have to bring into the discussion those implications for the economy. One of the things that you've had on your screen for a while that I'll now reference is that Alaskans are already paying more in income taxes than people in the rest of the country. And that may sound a little peculiar. The federal income tax schedule is the same for everyone, but there's a quirk here, or at least there's something worth mentioning. And that's that, as you all know, the cost of living is significantly higher in Alaska than it is in most of the rest of the country. And that's significant. Alaska households need to earn about $20,000 more than the median household income just to break even on purchasing power. And salaries, thankfully, at least partially reflect this. It's not 100%, but salaries are higher in Alaska than they are in the rest of the country. Partly that's the industry mix, partially that's a reflection of this cost of living. So the median household income in Alaska, most recent numbers were just under $78,000. The problem is that that's worth less than $60,000 in the lower 48. That's just that premium that you have, that higher cost of living. And of course, even though it's only worth $60,000 in the rest of the country, it's taxed as $78,000. There is an almost $5,000 differential there in federal income and payroll tax liability for a married couple. It's almost $6,700 for a single filer. Basically, at all levels of income, you are paying more in federal taxes for your sort of purchasing power adjusted income in Alaska than you are anywhere else. I have 2 columns here, and I'll explain what that is. One of them is all income, one's consumption adjusted income. The idea is that higher income individuals are going to be saving and investing a significant share of their income. And investment by Alaskans is going to face the same cost structure as investment anywhere else. We're in a global economy. You're investing in businesses around the country, around the world. You buy stocks. It's not the Alaska exchange. It's not an Alaska price premium. There's no difference on the return to saving or investment. But there is absolutely a difference for consumption. So we use figures for percentage of income that is consumed versus saved or invested at different income levels to do a consumption adjustment to say, okay, at the higher levels of income, some of this is not subject to that, cost of living adjustment. More of it is subject to that at lower levels of income. So you can see that in the other column, but you can see the additional tax liability, and it is substantial, whichever measure you use. At $100,000 for a single filer, it's $8,800 if you're not doing the consumption adjustment, about $7,400 if you are. That's a significant additional tax burden. In fact, let's put that into percentages. So here they are. And if that looks a lot like what you might see on, on an individual income tax, then, you're right. This is we're looking at a tax that's typically 6% or more. That is quite significant for what's a state that doesn't have an individual income tax. Right now, the median individual income tax rate, top rate in the country, is 5% exactly. That's a change over the last decade or so. In 2010, the median top rate was 6%. We've seen it coming down. So at this point, the median top rate is 5%, and it's actually continuing to decline, where we are looking based on the states that have already adopted reforms. When those are implemented, it should be getting down into the high 4s. And I think more states are going to be cutting individual income taxes in the near future. So again, in an average state, if you look in the lower 48, you're going to see maybe a rate of 5% as your top marginal rate. In Alaska, you don't have that individual income tax, but you're paying more in your purchasing power adjusted income to federal taxes to the tune of 6 or even more percent. If you have an individual income tax, it's kind of a double hit. It's like you're paying 2 income taxes if you were in most other states. So again, you can see those numbers on your screen right here. One of the other issues that comes up just generally when we talk about income taxes is volatility. Now, let's be clear. Any of the major taxes, income tax, sales tax, property tax, whatever volatility they may have, it is not nearly as significant of swings as you get when you have an industry-specific tax, like like taxing the oil industry. So any tax that you might add is going to be less volatile than that, which has its advantages. However, the income tax is what tends to have the most significant fluctuations, and they will track quite substantially with declines in the oil and gas industry. You can see this looking at the Great Recession, where individual and corporate income taxes dipped much more than sales taxes. I didn't put property taxes on here because those tend to be a local tax. They're even flatter. Whether that's good or ill is sort of a personal question you have to answer, because many would say, this is an ability to pay question. Your property taxes are staying flat while, the bottom's falling out on the economy and the market. But nonetheless, they tend to be a very stable form of revenue. Sales taxes tend to be pretty stable too. We reduce our consumption a little during economic downturns, but there's only so much we can. Income, especially capital gains income, falls substantially. And, especially in a state where, you're not capturing some forms of income. So you're not going to capture, say, the capital gains income of non-residents. Changes the volatility a little, but it also means that you don't get the upside. Capital gains income is a significant source of individual income tax revenue in most states, and you get that huge benefit in the good years and try to use it to buffer the bad years when it tends to slide substantially. For the seasonal employees who live elsewhere, if their residency is not in Alaska, if they're domiciled in another state, you can only tax the wage income. So you can tax the income that's earned in Alaska, but the capital gains income is not taxed there. That slightly improves volatility. It dramatically decreases the available revenue that is subject to an income tax in the state. But again, any of these taxes are going to be less volatile than the structure you have now, but the income tax tends to be the more volatile of those that are under consideration. You can just, sort of see the rationale for this in a subsequent slide where you see now that, adjusted gross income fluctuates quite a bit. Personal consumption doesn't fluctuate all that much, even in a recession. Let's talk now about some of the basic considerations, the economic considerations, if the state were to adopt an individual income tax going back to where it was a few decades ago. The first is that this is a tax on small businesses. The individual income tax is the tax that most businesses pay on income. The corporate income tax is paid by C corporations, but as everyone knows, there aren't a lot of C corporations as a percentage of all businesses. In Alaska, this is especially true. 99% of all businesses are structured as pass-through entities, meaning they're S corps, their LLCs, their partnerships, their sole proprietorships. All of them have their income passing or flowing through to the individual income tax form, if there is one. So these 99% of businesses, they are not currently paying an income tax in Alaska. They would be subject to one if it was imposed. And this is significant, given the higher cost of doing business in Alaska, and because of a level of, I wouldn't say pyramiding, but sort of a double hit that's associated with this, because it's a tax on both labor and capital. It's a tax on the capital investment to these businesses, on their investment returns, but it's also a tax on labor, on the workers themselves, which has a double effect. It reduces the return to labor, so it tends to reduce labor force participation, total labor output. It reduces the return that you're getting from working, but a lot of that is going to eventually be borne by the employer, who has to pay higher wages. So the businesses are not only paying on their profits, but they're also paying higher wages that aren't helping employees. It's not that they're getting greater paycheck, their after-tax income, but they are paying more because of the taxes. And this isn't unusual. I mean, this is how it works in most states, because 41 states do have a wage income tax. But again, I simply note that Alaska does have higher costs, and that the federal income tax is already providing a hit that isn't found in other states. And again, the sort of rates that Alaska would need to consider if this was going to be at all meaningful tax would be extraordinarily high, which raises significant concerns. It is really hard to raise substantial revenue from an individual income tax in Alaska based on income patterns, unless it's quite high. There are migration effects associated with income taxes, and it would be interesting to think about what that means for Alaska in particular. We know that the states that forego an individual income tax have twice the rate of population growth as the states that don't have one. And honestly, it would be higher if it weren't for Alaska. Alaska is the state that doesn't have the significant population growth despite not having an individual income tax. So I suppose you could say, well, it's not doing us any favors. The question is, well, if it's doing these enormous favors to 8 other states, is it holding back the opposite in Alaska? What does it look like if you do have an individual income tax and that cost of living and working in the state is even higher than it is now? We do now for Alaska, individuals can work somewhere other than where their employer is located. This can be good or bad. For some states, this is a huge opportunity. It's an opportunity to attract workers who like what the state has to offer, whether that's lower taxes, lower cost of living, amenities, the natural environment, whatever they may be looking for, they may be able to attract. The flip side of this is that even for businesses that have to be in your state because of the nature of their work, some of the back office jobs may not have to be in Alaska. So think of maybe some of the basic industries of the state. And obviously there's some jobs that you simply can't take anywhere else. They have to be there because that's where the work has to be done. But there are back office roles that may currently be done in Alaska, and the cost of living is already higher. There are advantages and disadvantages to being in Alaska. I love Alaska. I wish I could live in Alaska. But if an income tax makes the cost of continuing to work in Alaska too high for some people, they may easily be able to work elsewhere, even while remaining with a company that does work in or remains in Alaska. That is a threat and a risk that's more real now than it was pre-pandemic. Talked about the volatility. I'd mentioned again that limited fiscal capacity that you just you already have higher burdens in Alaska on income than you would in another state as a starting point. So in the paper that we published a month or so ago, which is available on the Alaska Policy Forum's website as well as on the Tax Foundation's website, we go through a literature review. We look at the various peer-reviewed studies on the effects of individual income taxes and on higher versus lower rates. And full disclosure, there's some there's some divergence. Not every study finds the exact same thing, but there are some themes that are overwhelming. So we review all this literature. You can look at all the major studies discussed in this paper, but the sort of top line version of this is that higher income tax rates are associated with significant outmigration, reduced in-state employment mobility, which means people go up the chain, they go up the rung of the ladder slower. You have less economic progress for individuals within their unemployment. It leads to lower gross state product. In fact, this is a very robust finding that GSP is reduced by income tax increases or the creation of income tax. Reduced investment, which is again a kind of obvious one, that the return to investment is lower. Therefore, some investments on the margin aren't going to be worth it anymore. And the risk factor in investments is going to be different. The risk evaluation is going to be different. And then patent formation is an interesting one. It's sort of a proxy. There's a couple of studies that say that patent formation is lower in states with higher income taxes, and that there is a strong correlation there. I think that's a good proxy for innovation more broadly. That the sort of research and development, the sort of investment that happens is going to be reduced in states that have higher income taxes. Thinking about what an income tax is and what it means. I think we had maybe a bit of an issue with recording, but we're recording again, I think. So an income tax is on all of your income, or at least most of your income, both that you're currently consuming and that which will be consumed in the future, your savings and your investments. That means that your consumption is being taxed twice, where is being taxed when you earn it, and at least at the local level with your sales tax, when you consume it. There's that double level of tax on the consumption element, and whatever you tax, you get less of. So you can't get around that. If you tax consumption, you will have less consumption on the margin. If you tax income, you will have less income on the margin. Anything that you're taxing, you're going to get less of, but you can choose what, and you can choose the economic efficiency of that. So do you want a tax on labor and an investment, or do you want a tax on consumption? Do you want a tax that sort of double taxes the consumption side and encourages you to consume faster rather than to invest? And that is why there is, I think, a trend across the country in reducing income taxes. Just since the start of 2021, we've seen 21 states reduce their individual income taxes. So this has been the most dramatic trend that we've seen in decades. 21 states have cut their individual income taxes since 2 years ago. Only the District of Columbia and New York have increased income taxes since that time. Why have they done this? Well, one, because revenues have been really robust. State tax revenues are higher than ever before. This is true kind of across the board. Sales tax revenues are higher. States that do have an income tax have seen income taxes higher, excise taxes, just pretty much everything you have. And obviously, at least for now, severance or you call them production tax revenues are much higher. This comes at a time when inflation means that people are facing very high costs and have a lot of pressures on them. And when there is more mobility than ever before, and people are increasingly making decisions based on their cost of living and on their tax costs. So states have been working on cutting taxes. That's why I think it's very significant that in Alaska, there is this discussion about creating a tax, because that's cutting against trend. It's not just that you would have it's not just that you would have. I'm sorry, I think we have some issues with Zoom. I think we're on the right slide. It's not just that you would have this situation where you are imposing a tax but people are standing still, but you would have many other states cutting and continuing to reduce their taxes while potentially you would be adopting something. So Arizona, Arkansas, Colorado, Georgia, Idaho, Indiana, Iowa, Kentucky, Louisiana, Mississippi, Missouri, Montana, Nebraska, New Hampshire, North Carolina, Ohio, Oklahoma, South Carolina, Tennessee, Utah, Wisconsin. That is the list. Thankfully, there's a slide there. Of states that have cut their individual income taxes, sometimes multiple times in the last 2 years. 3 of these have gone from a graduated rate to a flat income tax. 2 more are in the process of doing that. We are in a period of reduced reliance on income taxes, not increased or renewed reliance. There obviously haven't been a lot of new individual income taxes for a long time. But the last 2, one of which is new since Alaska last had one, are in Connecticut and New Jersey. Both of these were holdouts. In fact, Connecticut didn't get its income tax until 1991. Both of them were initially imposed as low-rate income taxes. They were flat income taxes. It didn't last. Both of them were sold as being an offset for something else to reduce reliance on property taxes or sales taxes and to provide some relief in other areas. New Jersey in particular, the idea was that schools were too reliant on the property taxes were consequently too high, and there needed to be an income tax as a release valve so they could reduce property taxes. Where are they now? Well, they have the highest property taxes in the country, and they have one of the highest individual income taxes in the country, top rate of 10.75%. It didn't offset anything. It just grew government. Connecticut thankfully hasn't gone to 10.75, but they do have a 6.99% individual income tax. They had initially hoped that it would not only remain low, like 2%, but also that it would be temporary. The plan was for it to go away. That has decidedly not happened. Again, it's a 6.99% rate. It is hard to get rid of these things. You did it once. If you adopt it again, that's probably it. So you have to decide, is this something that you really want, and what are the consequences of doing that, especially given that other states have been going largely in the opposite direction. The alternative, or at least an alternative, is a sales tax. And of course, you already have sales taxes at the municipal level. You're the only state that has local sales taxes, or at least that option, without having a state sales tax, which also makes you one of a very few states that does not have central sales tax administration. There's been some movement in that direction at the local level to consolidate and coordinate so that particularly remote sellers can work with one entity, trying to address some of the concerns post-Wayfair decision, which allows that remote seller taxation, to ensure that the collections come through, but also the burdens aren't exorbitantly high for remote sellers. So there's been some level of consolidation. But given that there's not a state level sales tax, there's not a single sales tax base. Different things are taxed in different jurisdictions. There's not a single point of collections, especially if you're an in-state seller. You have to remit separately and work with the jurisdictions individually. This causes a lot of friction. This is a high compliance cost regime. There are also pretty high local sales tax rates. The advantage, if there is one, of adopting a state sales tax is that you could conform all of this. You could have a single sales tax base. You could have a single point of collections. Of course, that opportunity is also a huge, huge challenge to bring all of the localities together, to make them all function under the same system, to allow the state to be the one collecting and remitting that tax. What you really need to do if you're going to adopt the state sales tax is to have them piggyback like almost every other state does. And every state that wants to collect remote sales tax does, then you need to do this. But you would be adopting a state sales tax and implementing that at a time when you already have high local sales tax rates. Partly that, again, reflects the unique economy of Alaska. If you look at the local option sales tax rates in most states, you tend to see rates of maybe 0.5 percentage point, 1%. You have obviously multiples of that in Alaska. That reduces the fiscal capacity for the state. You know, if you go in there with a 5 or 6% sales tax rate, and then you put those current municipal rates on top, you have double-digit rates in many jurisdictions. But what it also means is that you clearly have a revenue limit. That just the sales tax just doesn't raise as much revenue as it would in other states. This comes back to, again, that fundamental problem that the economy of Alaska makes it fairly difficult to raise substantial amounts of revenue from traditional taxes like the income and the sales tax. And that's a challenge. I mean, there's not an easy answer to this without incredibly high taxes that would be counterproductive. It's just difficult to raise that much revenue. If you did not have as much of an oil and gas economy as you had, it would be very difficult to fund government under any circumstances, under any tax regime. And you would have presumably a much, much smaller government. You'd have no choice. You're currently, again, spending more than 50% more than other states per capita. You wouldn't be able to afford that under any tax regime. You wouldn't be able to afford a fraction of that under any tax regime without the production tax revenue and the investment revenue that you have. Now, there are costs associated with being a low density state. Having population spread out as much as you have, having just the vastness of the state, it costs more to provide services in a state like Alaska than it does in a high population density state. Whether it should be 50 or 60% more, that's a question that I think needs to be asked, because these are expenditures that got run up at times when the oil and gas revenues were very high, and it was possible to do this, and it's becoming more difficult. But there's no panacea with an income tax, with a sales tax, with any other form of tax. There's only so much revenue you can raise. We're only talking about a tiny, tiny fraction of the revenue the state brings in from its existing sources. It's not going to be a huge buffer. It's not going to be a huge offset. It's going to be a significant burden on Alaskans. It's going to increase the cost of living, the cost of doing business, for relatively little gain in terms of overall state revenues. That's why whatever you do, it's going to be far more important to continue focusing on, providing reserves, to, do the rainy day approach with all of the constitutional budget reserve, the permanent fund, all of the funds that you have that help to smooth revenues over the course of years. That really is, even in a scenario where you have concerns, I think, about secular decline of revenues from the oil industry, that is the primary path that the state has to have. And, I think, fiscal discipline is extremely important as well, simply because there isn't really a silver bullet here. There isn't another tax that can just come in and replace what you have with oil and gas production taxes and the other taxes that are on the extractive industries. But comparing, at least, an income tax versus a sales tax. Like I said, the income tax is a tax on both, current and future consumption. It's a tax on labor and investment. A sales tax isn't that, so it's more economically efficient than an income tax. Economists tend to prefer it. The issue, of course, is that it can be regressive. It can impose a greater burden on lower income individuals. And this is because lower income individuals consume more of their income. More of that is going to be consumed on potentially things subject to the sales tax. Some of this is hard to control. But there are elements of that are within a policymaker's control. And a lot of that is the design of the sales tax base. In most states, The majority of goods are subject to the sales tax, but most personal services are not. That's really just a relic of when sales taxes were first adopted and implemented. It doesn't need to be that way. You could have a tax on personal services as well. In fact, you probably should. It's a tax on consumption. And we know that services are consumed more by higher income individuals. That doesn't eliminate regressivity, but it helps to swing the balance a little. It makes the tax more progressive than it would be. The sales tax is good, and it is, scales with ability to pay. And then, again, it's more economically efficient in a variety of ways. It really matters, though, how you design it. So sales taxes tend to be destination-based. What that means is that the sales tax is paid where a good or service is consumed or used, not where it is sold from. That's really important, especially for a state like Alaska. But then what's really important as well is how you tax or how you set the sales tax base. Every state includes at least some business activity in the sales tax base. They shouldn't. That's not part of the ideal design. Every state does it at least a little. Some do it a lot. And here's what happens if you put, put a lot of business inputs, intermediate transactions into the sales tax base. Not only is it pyramid, meaning that you have a tax imposed at multiple levels of production, and then they're all embedded into the price of the final product, but it changes what the sales tax is and puts Alaska businesses at a disadvantage compared to their peers in the rest of the country. Because normally, if an Alaska business is selling into another state and maybe it has a lower sales tax rate, well, the consumer or the company buying the product, whatever it may be, they're paying their state sales tax rate. It doesn't matter what Alaska's is. If, however, you put that tax on the business input, on that intermediate transaction, the business in Alaska has to pay it on their production in Alaska. It becomes a production tax, an investment tax, a business activity tax, rather than a consumption tax. Fundamentally flips what it is. And again, in a state with a higher cost of doing business, that is particularly burdensome. So if there ever was a sales tax, that design consideration is extremely important. These are not easy questions. I don't think there are easy answers for Alaska, and I do think that there are going to be significant challenges in the days ahead. But nonetheless, I do think it's important to understand what the economic implications of an income tax and also a sales tax are for Alaska, and to have a sense of what impact it has. Because I think sometimes the assumption has been, if we adopt an income tax, it'll raise the sort of revenue we see in other states, it'll put us on a different course. And again, in fiscal 2021, it would have increased revenues by 1%. This is a lot of activity. This is a lot of impact on your state's economy for something that small. I'll wrap it up with that. We do have a paper that's available on the Alaska Policy Forum's website and Tax Foundation's website. And if we did have questions, I'm happy to field them.
Thank you, Jared, for your expertise and the amount of information. We're running a little long, so I apologize to members attending, but we would like to keep pushing for a few extra minutes because we have a few questions that came from the audience. And I'd like to acknowledge also that we have several elected officials, and just wanted to thank them for their time. And please remember that we're recording this. We're going to make it available on both our website and Facebook. And so if you have to leave or if you miss parts of it, you'll be able to watch it. So the first question I want to ask you is, how much will it cost the state of Alaska to implement and manage a tax collection division?
That's a good question to which I don't know if I have an answer. Typically, states are probably spending a few percentage points of the revenue they bring in on overall tax collections. Broader taxes cost less to administer than narrower ones. The sales tax costs less to administer than an income tax simply because there are relatively few remitters. It's just vendors. And while there's a lot of them, there's not nearly as many as there are, obviously income earners. You do get the federal income tax data, but there's still a lot of follow-up that they have to do. And again, when it's a relatively small source of revenue, those numbers become a little more significant than they would otherwise.
Okay. What grade would you give Alaska's tax system right now if you compare it to other states? And I know you covered some of that, but what would be the grade?
For anyone not in the oil and gas industry, you're probably getting an A. There are a lot of challenges in doing business in Alaska. There are costs associated with living in Alaska, wonderful state that it is, but there's not a lot of direct tax burden on individuals. Sales tax at the borough level, property taxes in many jurisdictions, but no individual income tax, not a bad corporate income tax, very low tax burdens.
Okay. Another question is, if we are already paying a higher federal income tax, wouldn't it make more sense to install a state tax to keep more money in state through the SALT deduction?
It's an interesting question. The reality is that you're not. So right now, you have a choice when you're doing your state taxes. You can take property taxes as a deduction and your choice of sales or income taxes. Now, in most states, that's an easy choice. You do income taxes. In Alaska, assuming you are in a jurisdiction, like most jurisdictions with population centers, that has a sales tax, you would do the sales tax. And you're not actually like doing the numbers yourself. You're using an IRS calculator that's saying, okay, based on your income, here's your assumed level of consumption. If you adopted income tax, while there's still those borough level sales taxes, you lose the deduction on the sales tax because you can only do one. And this is true of most states where you only get part of the deduction, but there's a huge advantage to being in a state that just has one of those two because you actually get to deduct more. Now, right now it's a $10,000 cap. Many people, of course, assume that that's going to go away and that this will be an unlimited cap. But of course, as a deduction, not a credit, it's not like there's a significant additional burden regardless. And again, if you put this on top of the municipal sales tax, you'd be losing the benefit of that deduction to gain it on the income tax side.
Thank you so much for explaining that. How you already mentioned the local sales taxes, but how would really implementing a statewide sales tax impact those boroughs and cities which have their own sales taxes in place? I mean, this is a question that people ask all the time, and I think it's very important to just mention it again with a little more details if you can. But this is going to be our last question.
Yeah. Alaska is in a unique situation. To the best of my knowledge, there's no other state that has ever had local sales taxes before they had a state sales tax. So the local sales taxes have always been sort of at the license of the state, and therefore were usually administered by them with the parameters the state set. Often there's a cap on what the local rates can be. Sometimes there's just this is the local rate, but that's not always the case. States typically set the sales tax base and all the localities use it. Administration is through the state, audit is through the state. Basically, the state runs it all and they just disperse revenue to the localities for their local share based on the sales that were transacted in that jurisdiction. With Alaska already having municipal governments, the boroughs running this on their own, if you were to adopt a system that pretty much every other state does, you would have to subsume that into the state. The boroughs would lose their authority and they would still have local sales taxes, but it would be at the state base, collected by the state, maybe with caps on the rate. These are things that are not easy to do. There's a couple of states where the locals have some of that autonomous authority, Louisiana, Colorado. That's really challenging. They can't do remote sales tax collections right now. For instance, Louisiana has a patch for it where they just have a single system if you're an out-of-state seller, and it kind of works. But it's almost impossible and constitutionally suspect to have this separate administration and separate bases if you have state sales tax. The great news is you get the system right. The bad news is because you're not starting at that point, it is incredibly hard to bring those jurisdictions in and do this.
Thank you so much for your expertise and for agreeing to do this very timely and very informative webinar. Again, thank you. This has been great, and we hope to have you again in the future. I want to leave instructions for everyone to sign up for our newsletter and to get updates about the work that we're doing. If you like this webinar, we will have different webinars throughout the year, and it would be great to have all of you attending. So if you go to our website, alaskapolicyforum.org, on the upper left corner, there's a subscribe button in there. So you go and fill out the form, you click submit, and then you're going to get an email with a link that you have to click in order to confirm your registration. And so thank you so much for taking the time. Jared, again, thank you so much for everything you do and the information. And we will see you all soon. Thanks.